Welcome to the Agronomy and Farm Management Podcast. I'm Amanda.
And I'm Elizabeth. Thanks for joining us today.
Welcome back to the Agronomy and Farm Management Podcast. Today we're talking about taxes. There's been a lot of payments and things like that come into play this year. So we have Barry Ward with us. He's the director of the OSU Income Tax Schools with OSU Extension. So thanks for coming on, Barry.
My pleasure.
One of the things I think that comes to the forefront is prevented plant. We had a lot of that across the state this year, and there are some insurance payments being made. So what are the options farmers have with those payments?
Yeah, right, Amanda. We've got some unusual types of payments this year, so farmers are having to deal with a lot of different tax implications with these different payments. The number one thing that we've dealt with this year throughout Ohio is prevent plant indemnity payments. You know, they're going to be receiving these if they haven't already, and they're going to wonder how they're going to insert those into their tax planning. So luckily we have some flexibility. You know, we have the ability to defer these prevent plant indemnity payments. Now, crop insurance payments can be deferred if they're due to some type of yield loss. In other words, some kind of natural damage, naturally occurring damage. So that's something that we can look forward to as a planning piece. Farmers have to fall into a certain category to be able to defer those indemnity payments. However, they have to prove that historically or in the recent past they have sold at least half of their crop in the next year. Okay. So that's a big key point that they're going to have to be able to prove if they were to be audited. So if they can get over that hurdle, if they can meet that criteria, then they can look to defer those crop insurance payments that they may receive.
So if you're used to just selling all of your crop at harvest, then you're not going to be eligible.
You will not be eligible to defer those crop insurance payments. So, but if you are selling, half and half, for instance, and it's over 50%, and there's some case law that will support that. So there's some tax court decisions that have basically set some precedent there. But if you are typically selling over half of your corn, for instance, into next year, and you have a lot of crop insurance prevent plant payments for corn acres that you didn't plant, then you can defer it. Now, it's an all or nothing type of an election, so you have to make this election with your tax preparer. You have to talk to them, or if you're doing your own, you have to make a special election. So there has to be an addendum to your tax forms. But if you want to do it, you can have that flexibility.
Okay, great.
So the other payment that a lot of farmers in Ohio are getting this year is going to be from the market facilitation program.
Yeah.
So is that different, the way that we can handle that?
It is, yeah. That market facilitation payment is being paid primarily because of loss due to trade, and that's strictly on price. So the tax law is fairly clear. Anything that's related to a price-related payment is not deferrable. So those payments aren't deferrable as the others are. So it does kind of put our producers in a box a little bit. They don't have a lot of flexibility. And it's going to be a problem for some because the 2018 market facilitation payments that producers received, some of them waited until December of that year to report and didn't receive those until into January of 2019. So they've got most all of those 2018 market facilitation payments that were received in 19, and now they're receiving this next round. At least they received 50%, and maybe we're going to get another 25% here this next month. So there's going to be a pretty good slug of MFP payments that these guys are really not going to have any option to do anything with. So that's something that is going to create some headaches, I think, for some people in planning. So, yeah.
It'd be nice if they would make those payments at different times, I guess.
Yeah, it would. And I think waited and took them in 19, so it's going to be a big slug of payments. I don't think many people were really expecting a second round or third, however you define it. But Now, the thing that people can do is they can look at income averaging. So farmers and fishermen, oddly enough, have the ability to take a chunk of their income, net income, in the current year and distribute it evenly in the prior 3 years. And really, it's if we see a point where we have the last 3 years of low income years and this year is a real high income year, it's a nice tool to even that income out. So now there may not be too many because we had pretty good yields in Ohio in 17 and 18 that kept incomes, I think, at a decent level for most, but there may be the odd producer here and there that had some weather problems and lower incomes that it might be a tool they can use.
Now, one program that we might have a lot of people new to is cost share programs with the cover crops that went in.
Yeah.
Talk a little bit about how that will work with their taxes receiving those cost share payments.
That's pretty straightforward. They're going to, if they receive cost share payments in 19 this year, they're going to receive that, whatever that cost share payment was, it's going to show up on their 1099-G, which they're going to receive from the government. And that's, they have to declare that income in the current year. So there's no deferring that income, unfortunately. There's little flexibility there.
Okay, so just to recap, we've got the MFP payments and the cost share that cannot be deferred, but the PP, the prevented plant insurance payments can be.
Can be, yes, and that's a good summary. And again, the PP payments, those that's an all or nothing. So if they're going to try to defer any of that, they have to defer all into 2020.
Yeah, that's good information, and that income averaging sounds like a good strategy. That's an opportunity perhaps to help level things out if this year is a challenging year with income.
Yeah, it can be. I mean, as we looked at things in May and June, I don't think we thought that many growers were going to have high incomes, but I think it's going to work out to where some of them might see a spike just because of those MFP payments kind of all being in the same tax year.
Yeah, that's one of those you wish you could go back in time if you took that payment in 2019.
Yeah.
But we didn't know we would still be in this boat at this point.
Right, exactly.
Well, I think that goes with the prevented plant payments too. You could defer those, but you never know what the next year is going to be like.
That's right. 2020 may be a bumper crop with high prices, but I'm not going to hold my breath on that.
Yeah, so we were chatting earlier that not a lot has changed in the tax world recently, but one thing that has is the way that they're going to handle like-kind exchange with farm equipment.
Yeah, with the new tax law that was passed the end of December or December of 17. So we've had a couple years to kind of digest all of the tax changes, and I think everyone's understanding how they can claim there's a QBI deduction, a 20% deduction that most farmers are eligible for. And that's pretty straightforward. But the one thing that's kind of caught people unawares, I guess, is the new like-kind exchange rules. The new tax law that was passed declared that 1031 like-kind exchanges could still be used for real property. In other words, land and buildings. So we still have the ability to do that like-kind exchange transaction and essentially not have any tax due. We defer the tax. Now, they took that away, or they eliminated that like-kind exchange possibility for farm equipment, for all other property, in other words. So where it hits farmers is farm equipment. They buy and sell a lot of farm equipment. They trade in a lot, right? So that's something that what we end up with is a taxable transaction when they trade in a piece of farm equipment. So what the numbers look like, most of the time, farmers have a piece of equipment that's fully expensed. That when they buy a new tractor, they typically write off the entire expense in the year of purchase. Okay, so they take Section 179 expensing or bonus depreciation, they write it off in the year of purchase or very quickly. So when they go to trade it in, what they have is an asset that has no tax basis. It's at zero. So every, whatever they traded in for, they essentially would have a tax due. Now, in the past, that 1031 exchange essentially wiped that out, and you wouldn't have had to pay tax in that year. Now we have to. Okay, so we have a $200,000 tractor that we're going to trade in. Has no tax basis. We're going to buy a new tractor for $300,000. So the boot would have been $100,000, right? So that trade-in would have been simple in the past. Now it's not. So now they have to pay tax on that tractor that they're trading in, but they can write off the full amount of the new tractor. I know that's the implications, I think, are more important. Okay, what they can do is essentially offset it. So it's not going to be a huge effect as far as tax, but there's going to be a benefit for some of them, but there's also going to be some implications that are negative. The benefit is that the trade-in essentially eliminates some self-employment tax. So that's pretty big, 15.3%. So they eliminate some of that, but on the other hand, state of Ohio tax rules are not the same. They don't match up perfectly with the federal tax law. So what we end up with is a higher state tax on this tractor trade-in or whatever equipment we're trading in, a lower self-employment tax, and then perhaps possible implications for Social Security. And if farmers are considering and thinking about Social Security as a possible part of their retirement, this new mix of income that they're going to get from this new tax law will perhaps give them less Social Security credits and subsequently less Social Security when they retire. So there's 2 or 3 factors at play here that they need to consider and talk to their tax practitioner about. And it's messy. And I've had more than one farmer that have approached me about this new implication for the higher tax on their Ohio taxes due to this new law. And it's a problem. I mean, it's going to be a significant increase in their state of Ohio taxes on some of these tractor trade-ins.
Wow.
So more than you wanted to know. It requires really looking at the numbers other than just kind of me trying to explain it. It's really difficult to explain like this, and I know that it's...
No, I think that's an important point to bring up, and like you said, working with their tax practitioner to run the numbers and see what it's going to look like maybe before they decide to make a purchase.
Yeah, I mean, it's something that where I've seen it really impact farmers is where they're maybe looking at 2 or 3 pieces of equipment. They do get some benefit with the dealer if they're going to do multi-piece trade-in each year. So if they do that, they're going to be pushing some of that income into a higher tax bracket on their Ohio taxes, and it's going to be a higher amount. So they may consider maybe weighing the benefits of the multi-piece trade-in versus the higher tax rate, and maybe piecing it out over multiple years. Mm-hmm. But some of these growers, they have to be trading in 2 or 3 pieces a year, so they may not be able to escape that.
Right, so let's talk a little bit about tax strategy. You mentioned when we were talking earlier about the QBI deduction.
Yeah.
So how can farmers use that?
Right. Yeah. This is a new deduction as a part of the new tax law, the Tax Cuts and Jobs Act, and it goes under many different names. The technical term is the Qualified Business Income Deduction, or QBI deduction. It's also been called the pass-through deduction, or just simply the business deduction. It's for all businesses other than C corporations will qualify for this. Trusts and estates, it's a bit different as far as how they claim this, but what it is essentially is a 20% deduction on qualified business income. Now that term is a bit complicated in itself, but mostly for farmers it's going to be Schedule F income, their net income, and they're perhaps going to get up to 20% of a deduction on that income that they're going to then be able to deduct and before they calculate taxes. So it's pretty significant. And most growers and most farmers are going to qualify for the full 20%. It's one of those things where if we have a high enough income, net income, we start to see phase outs, or what they call limitation phase ins, which to me is quite funny because this is the IRS, right? And they come up with really strange terms for some of the things that they do. But so we have limitation phase ins, but it doesn't kick in, for a married couple or a joint filer, it's $321,400 of net farm income. Now some will get to that point. We have some larger farmers that perhaps might meet that, but for most, they're going to qualify effectively for the 20% deduction, and it's significant. So that's something that I think growers are probably already keyed into a little bit with the last couple of years. The other thing I'll just add is it is a slightly different deduction and calculation for cooperatives. So if a farmer has sales to cooperatives and sales to independents, so if they sell part of their grain to a cooperative and part of their grain to, let's say, Cargill, which is a non-cooperative, they're going to have to treat that slightly different. Okay. Now, most of it they're just going to hand off to their tax practitioner because, let's face it, most of these guys and ladies, they're going to be working with tax professionals that work with this every day. However, it's important for them to know strategy and be able to communicate so they can do some better planning. So make sure you're having discussions, I guess, is what my recommendation would be with your tax preparer, and understand the ramifications of sales to both cooperatives and independents. Now, there's no real clear advantage. However, there can be, depending on their mix of payments that are coming back from the cooperative, so patronage dividends as a result of this new deduction, because the cooperatives have new tax laws too, as far as what they can provide back to their patrons. And then it also has a little bit to do with how much labor a farmer will employ. Okay. Strangely enough, so how much W-2 wage income a farmer is paying someone will impact this deduction calculation for cooperatives. So more than you wanted to know, but the thing that farmers should realize is you're going to have to separate out the sales to cooperatives and non-cooperatives, and then you're going to have to find some way to separate the expenses. So allocating the expenses to bushels that were sold to cooperatives, I know, and bushels that are sold to independents, and it can be very simple. It can just be on a per unit basis, Okay. But they can also, if they do it field by field, they can do it that way. If they want to get real complicated, the thing that the IRS has come out with this summer is once they choose a method to allocate expenses, they have to stick with it.
Good information. Thank you.
No problem.
No, so you have your tax schools coming up.
Yeah.
When are those?
Well, we have our tax schools throughout the month of November and early December, and those are 2-day tax schools for tax professionals. Probably not for your lay person. Mm-hmm. We do get some farmers that do come because they are doing all of their own complex accounting, or they may have someone on staff that's doing that, and also they'll follow up with doing their own taxes. So we do get some that aren't qualified, CPAs or enrolled agents that come, and we want to welcome everyone, obviously. So you two come too. You're invited. But those tax schools are for tax professionals, 2 days, pretty in depth, and that's kind of where we start. Now we also have a couple of webinars. One is December 16th, and that's a 5-hour webinar. It's an all-day webinar for also kind of geared towards tax professionals, but it's all on agriculture. So if you want just ag-related tax issues, we'd certainly welcome you to that. And it's somewhat high level, but it's something that I think the lay person also could benefit from. And then we have one more, and that's going to be the one in January, and January 13th in the afternoon, 1 to 3, and that's our farmer tax webinar. And that's for just, everyone. And also farmland owners. So we'll also have some some facts in there for those that own farmland and may not farm.
Okay, great. So some of these topics that we touched on, just maybe a little more in depth.
Yeah, we will definitely hit all these topics and more in depth, and some other key features that we see as important for planning. There's some strategy that farmers can look at as well.
Yeah. So Barry, this has been great. Are there any other resources you'd like to point people to if they want to learn more?
Yeah, we've got a good website. So I'll mention our farm office website, and that's a joint venture between a few of us that are doing kind of ag law and tax and farm management. So just Google Farm Office, and you can find that pretty easily. And that's where all of our tax school information is, and people can find dates, and be able to register, and also access some of the articles that we've written the last year.
Yeah, and we'll include the link in the description.
Okay, great.
Well, thank you, Barry. Appreciate the time, and I'm sure
pleasure.
we'll see you around a lot this winter at meetings.
I hope so. And good luck to everyone with their tax year.
I just want to remind our listeners that we do have our new website, go.osu.edu/AFM. If you want to listen to past episodes or hit some of those links, check out the bios of our past interviewees as well. So check that out. Remember to like us and give us 5-star ratings and all that wherever you're listening. Thank you.
Thanks for listening to the Agronomy and Farm Management Podcast. Join us again in 2 weeks for our next episode.